Good morning, everyone. My name is Andhika Rizkiko, and today I'll be presenting a stock valuation and strategic investment outlook for the GOTO Group. This report is based on an independent analysis of GOTO's financial performance, strategic positioning, risk exposure, and long-term financial potential. potential. The purpose of this presentation is to assist potential investor in understanding the current state of the company and to provide a clear data-driven recommendation. Now, let's begin with a look at who GOTO is and how it has evolved post-merger. With, we begin with an overview of the GOTO Group, one of the most ambitious tech companies in Southeast Asia. GOTO was established in 2021 through the landmark merger of Gojek, known for ride-hailing and delivery, and Tokopedia, one of Indonesia's largest e-commerce platforms. Together, they form a super app ecosystem integrating three business pillars: mobility, commerce, and fintech. The fintech division, GOTO Financial, handles everything from payment to lending. This merger aims to build an integrated and end-to-end digital infrastructure for Indonesia's growing tech economy. Post IPO, GoTo undertook a strategic shift, divesting non-core operations such as logistics, fulfillment services, and underperforming subsidiaries. This divestment was necessary to reduce operational complexity, improve cost efficiency, and sharpen focus on profitability. GoTo's IPO in April 2022 served three purposes. First, to raise capital needed to fund its cash burning operation and support future expansion. And second, to strengthen its public image as a national tech champion, and also to provide liquidity for early stage investors and employees. However, GoTo operates in an extremely competitive market. And ride hailing delivery, there is Grab, who remains a dominant regional force, and in e-commerce, Shopee through the C Group maintains a strong market leadership. And now TikTok Shop is entering the scene, disrupting the social commerce models. To compete, GoTo poured a massive investment into discounts, driver subsidies, and infrastructure. While this grew market share, it came at the cost of skyrocketing expenses, particularly at SG&A. Now, moving on to GoTo operational efficiency and profitability outlook. GoTo selling general and administrative expenses have been extraordinarily high. In 2020, SGA costs reached at 19.2 trillion, while revenue stood at just 4.5 trillion, for over four times the revenue figure. In 2021, SG&A expenses peaked at 33, 31.4 trillion, still nearly three times company revenue. Although these costs have come down now at around 16% of revenue by 2024, they still consume a large portion of earnings. This indicates persistent operational inefficiency and presents a clear barrier to profitability. The problem is actually deeper than just high spending. Revenue is indeed growing, but expenses are growing faster. If a company's structure consistently outpaces its income growth, it's not on a sustainable financial path. This remains true even if revenue is increasing. Now, GoTo's risk profile also deserves attention. There are three major external risks investors must weigh. First one is the intense competition from regional players and also regulatory challenges, especially in GoTo's fintech division, which includes GoPay, and concerns include data privacy laws, growing ownership regulation, and financial licensing risk. And the third one is the macroeconomic instability, including currency volatility and persistent inflation, could pressure margins and dampen investor confidence. Now, the net loss in 2023 stood at minus 5.33 trillion, and even the projected net loss in 2024 is still significant at minus 3.1 trillion. The path to profitability is long, with break-even not expected before 2026, and even then, it's not guaranteed. So, to summarize this slide, GoTo's biggest challenges is not whether it can grow, it's that its current growth is being bought out at an unsustainable cost. Now, let's take a look at GoTo's financial fundamentals based on our analysis. From a simplified income statement perspective, revenue is growing, which is encouraging. but losses are narrowing, showing that efficiency efforts may be starting to take effect. However, net income remains negative, and profitability is not forecasted until 2026 at the earliest. On the balance sheet side, as of 2024, GOTO holds 20.9 trillion in cash and equivalents. It carries only 4 trillion in debt, giving it a strong net cash positioning. And also, it has no leased liabilities on previous stock, which help maintain flexibility. This liquidity means GOTO has the resources to cover its short-term burn. However, the long-term outlook depends entirely on two things. The first one is how GOTO can reduce the SGA further and also improving gross margins. Despite the risks we have outlined, there is no denying that GOTO has shown some operational improvement. And the key question is whether these improvements are enough and whether they are sustainable. Now, last slide. Finally, let's discuss our investment recommendation based on the valuation. After projecting GOTO's cash flows and discounting them using a conservative weighted average cost of capital, we found that GOTO's stock is overvalued by more than 40% compared to its intrinsic value. This suggests that the market may be overestimating GOTO's long-term growth potential or underestimating the execution and risk factor we have covered. Zooming out, we also need to consider the broader investment environment. Post-election, such as post-election political transition in Indonesia could lead to new policies that impact the tech and fintech landscape. Also, the higher global interest rates will make future capital raise more expensive. And the last one is we may see a shift in investor sentiment from growth stories to cash-generating stable companies. So our final investment call is we have to sell. Here's why. The stock is significantly overvalued relative to intrinsic DCF value. SGA and other operating expenses continue to drag down earning potential. No net profitability is expected until 2026 and until 2027, delaying value creation, and macro regulatory risk continue to cloud the long-term picture. So our strategic insight for investor is GOTO is promising platform, but it's still burning cash. With profitability years away and competitive pressure driving up costs, the prudent move is to exit or wait on the sidelines until GOTO proves it can deliver operational efficiency. Okay, this concludes my presentation on GOTO stock valuation. Thank you once again for your attention and time. I'm happy to answer any question or discussion. Thank you.